Okay, let's jump right in. If you've ever felt that magnetic pull of day trading, you are definitely not alone. The dream of quick profits is a powerful one, but for so many beginners, the reality is, well, it's a painful cycle of buying high, selling low, and just completely blowing up their account. Today, we're going to build a roadmap to make sure that doesn't happen to you. Let's be honest for a second. Does this feel a little too familiar? You see a stock that's just rocketing up, you get that FOMO, you jump in thinking it's headed to the moon, and then bam! The price just slams into reverse, and you're left holding the bag at literally the worst possible price of the day. It's frustrating, it's demoralizing, and believe me, it happens to almost everyone. But here's the good news. You're not crazy. This experience actually has a name. It's the classic breakout trading trap, and it is specifically designed to catch new traders who haven't been let in on a few really crucial secrets. Now, what's so wild about this is how blunt it is. This comes directly from trading educators who see this exact mistake every single day. The conventional wisdom, buy high and sell even higher, it sounds so simple, right? But in the real world, it's one of the fastest ways to drain your account. So clearly we need a better way. So first, let's just make sure we're all on the same page. What even is a breakout? It's simply that moment when a price moves past a really significant, predefined level on your chart. Think of it like a prisoner escaping a jail cell. These levels are like psychological battlegrounds, and when one side finally wins, the price can move explosively. Our job is to figure out which breakouts are the real deal and which ones are just traps. The very first step in avoiding that trap isn't some secret indicator. It's choosing the right tool for the job. So forget about trying to trade those crazy penny stocks or expensive blue chips. For beginners, the game starts with an instrument that's literally designed to help you manage your risk: micro futures. And this right here is the key. The Micro E-mini, or MES as it's called, it tracks the S&P 500, one of the most important indexes in the entire world. But, and this is a big but, it does so at 1/10 the size of the standard contract. Now, this isn't just some small detail. It fundamentally changes the amount of risk you're taking on every single trade. And this just perfectly illustrates the difference. Over on the left with the MES, you've got much smaller risk and a lower margin requirement, which means you need less cash just to place a trade. On the right, the standard ES contract, it just magnifies everything: the risk, the capital you need, and honestly, the stress. They both follow the exact same price, but their impact on your wallet is just worlds apart. Let's make this crystal clear. When you're trading the Micro E-mini, the smallest possible price move, traders call it a tick, is worth just $1.25. That's it. It's a manageable amount that actually lets you learn the ropes without getting totally wiped out. Now look at this. For the standard E-mini, that exact same tick is worth $12.50. That's 10 times more. A small move against you that would have been a minor paper cut with the MES, well, it becomes a deep wound with the ES. This is exactly why starting small is non-negotiable. So what does this actually mean for your bank account? Well, you can open a futures account with as little as $500. But to be practical and give yourself a little bit of a buffer, a starting capital around $1,500 is a much more realistic recommendation. All of a sudden, day trading doesn't seem to require a fortune to get started, right? Okay, so you have the right tool. Now let's build out the playbook. We're going to look at two simple but really effective strategies that focus on one critical element most beginners just totally ignore, and that is confirmation. Our first strategy is just beautiful in its simplicity. We're not just looking for a price to break a level, we are demanding proof. And that proof comes from volume. A breakout without volume is like a car revving its engine but going nowhere. It's all just noise. So here's the play, step by step. First, you identify that line of resistance. Second, you wait patiently for the price to move above it. Third, and this is the crucial part, you look down at your volume indicator. Do you see a big surge of buying coming in? If yes, that's your signal to go long. And your exit strategy is just as clear. You get out at the very first sign of heavy selling pressure, also confirmed by a spike in volume, and you take your profits. Now, the second strategy uses a slightly more sophisticated tool: the volume-weighted moving average, or VWMA. The easiest way to think of it is as a smart moving average. It pays more attention to the price levels where a lot of trading, a lot of volume actually happened. The process is really similar. You add that 20-period VLWMA to your chart. Now, you're looking for a breakout that clears both your trend line and the VLWMA. That's your double confirmation to go long. And what's great about this is the VLWMA then often acts as a sort of dynamic support level. So when the price finally breaks back below it, that's your clear, totally unemotional signal that it's time to exit the trade. Now for maybe the biggest question of all. This is great, but how in the world am I supposed to do this when I have a full-time job? Most people think they have to be glued to their screen from 9:30 a.m. to 4 p.m., and that is just a myth. And this right here is why. The futures market, it doesn't really sleep. It trades pretty much around the clock with just a little 1-hour break each weekday. And this gives you an incredible amount of flexibility to find a trading window that fits your schedule, not Wall Street's. You see, the trading day is really just a series of overlapping sessions. When Europe opens, a wave of volume flows into the market. When the US opens, an even bigger wave flows in. And when Asia opens, the cycle just begins all over again. The key is to trade when these sessions are providing volatility, no matter what time zone you're actually in. So, the bottom line is this. For someone working at 9 to 5, there are perfect windows of opportunity. You can trade the pre-market session before you even start your commute. Or you can trade in the evening when the Asian and European sessions get active again. The opportunities are absolutely there. Okay, so we've covered the tool, the playbook, and the timing. But none of it matters without this final piece, the rules that will keep you in the game long enough to actually succeed. This is what separates the professionals from the amateurs. I want you to forget about making money. Your first, second, and third job as a new trader is to protect what you have. A trader with capital can always trade tomorrow. A trader with no capital is out of the game. You have to be a risk manager first and a profit seeker second. And this is how you preserve that capital. You never risk more than a tiny fraction of your account on a single trade. Most professionals stick to a 1 to 3% rule. This discipline is what ensures that 1 or 2 bad trades won't completely destroy you, and it allows you to survive the inevitable losing streaks. An entry without an exit plan is not a trade, it's just a gamble. Before you ever even think about clicking the buy button, you have to know 2 things: exactly where you're going to take your profits, and, more importantly, exactly where you will admit you were wrong and cut your losses. So there it is, a clear roadmap. Start with microfutures, use a simple, volume-confirmed strategy, trade during the hours that fit your life, and manage your risk obsessively. The information is all right here. Now the only question left is, do you have the discipline to actually follow it?